You are not poor because you earn little money. You are poor because every time you earn more, you unconsciously spend it all before it has a chance to become an asset. Part 1. The most dangerous trap: lifestyle creep. There is a paradox that is very hard to accept. The more money you earn, the easier it is to become financially stuck, not because you are not good enough, but because your spending system has upgraded faster than your accumulation system. You think you are upgrading your life, but in reality, you are upgrading your cost of existence. In behavioral economics, there is a concept called Diderot effect. Simply put, a small upgrade will trigger a series of other upgrades with no stopping point. You buy a beautiful chair, the table becomes ugly. You change to a new phone, your old laptop looks outdated. You move to a better apartment, the surrounding area starts to feel not classy enough. There is nothing wrong with each individual decision. The problem is, all of them combine into an endless chain of spending. A report by Goldman Sachs shows nearly 40% of people earning more than $500,000 USD per year still live paycheck to paycheck. Even more, the higher the income group, this rate does not significantly decrease. What does that mean? It's not that they don't earn enough money. It's that they have upgraded their spending faster than their income. Imagine this. In the first year, you earn $20 million per month. You live comfortably. In the second year, you earn $40 million. You change your car. In the third year, you earn $80 million. You move house. In the fourth year, you earn $150 million. You change your living environment. And friends. Standards. And then you look back, you earn 7 times more than before. But the financial feeling is no different. Even more pressure. You don't spend money because you need to. You spend money because you are trying to maintain a new version of yourself. This is what most people don't realize. Income increases in steps, but spending increases as an ecosystem. Each upgrade is not just a one-time cost. It creates long-term maintenance cost. A more expensive car, higher maintenance costs. A bigger house, higher operating costs. A more upscale environment, higher social standards, and you get locked into that system. This is why truly wealthy people look very normal, while those trying to appear rich always feel short on money. A simple principle that almost no one follows. When income increases, increase savings first, spend later. For example, you get a salary increase of $20 million. 10 to 12 million must go straight into investments before you even have time to feel richer. If you were earning more than 2 to 3 years ago, but your account has not changed much, you may not lack income. You are caught in this exact trap. And more dangerously, when you start to become somewhat successful, another trap, even more subtle, will appear, making you believe you are very skilled, while in reality, you are getting closer to losing money faster than ever before. Part 2. The dangerous trap of success overconfidence. You start making money, a few correct investment decisions, your account grows, and then a very small thought appears. Maybe I'm actually good. This is the point where many people start to go off track. Not because they are stupid, but because they were right too early. A few winning investments do not prove you have skill. It only proves you are in the right moment of the market. In financial psychology, this phenomenon is called self-attribution bias. When you win, you think it's because you are skilled. When you lose, you blame the market. Bad news or bad luck. Your brain is protecting your ego but destroying your assets. A study tracking nearly 20,000 traders, after more than 300 days, 97% lost money. There is almost no evidence they improved. Over time, the scariest part, the longer they trade, the worse the results. You start with simple investing ETF, large cap stocks, long-term strategy. You make money, then you begin picking individual stocks, trading more frequently, using margin, trying options. You think, if I do more, I will earn more. But the reality is, you are leaving the safe system and entering a game where you have no advantage. The market going up is not feedback for your skill. It is just a favorable context. People who are truly good with money do not ask, "How much did I earn?" They ask, "Did this result come from skill or just luck?" Because they understand if you confuse the two, you will increase risk at the exact moment you should reduce it. Not when you are losing money, but when you are winning and starting to change your strategy. That is when you leave discipline and move closer to the biggest mistake. The most effective strategy sounds very boring. Invest consistently. Diversify. Do not interfere too much. When investing starts to feel exciting, that is usually a warning sign, not an opportunity. If you have ever had a big winning investment and then started to feel more confident than usual, pause for a moment. You may not be improving. You may just be deceived by the market. And when this confidence combines with another mistake, everything becomes far more dangerous. Because at that point, you don't just believe you are right. You start putting all your assets into a single thing. Part 3, the all-into-one trap overconcentration. You were right before. You start believing in your choice, and then you do something very logical. Put more money into what has already made you money. At this point, the problem is no longer knowledge, but the emotional relationship between you and the asset. You no longer see it as an investment, you see it as a belief. You hold it not because of data, but because you don't want to be wrong. When an asset rises sharply, it triggers two things: self-validation. I was right. Emotional attachment. This thing is special. And from there, a trap is formed. You no longer evaluate risk. You only defend your past decision. Market history shows about 40% of stocks have dropped more than 70% and never recovered. In technology, this number is even higher, which means an asset that was once very good does not mean it will continue to be. So imagine this. You buy a stock at a low price, it triples. You start talking about it, your friends know about it, you believe in it, and then 60% of your assets are in it. At this point, you are no longer investing, you are gambling. The risk does not come from choosing wrong at the beginning. It comes from being right for too long about one thing. People who are good with money do not try to find a big winning bet. Try to avoid a catastrophic loss. Because they understand you can be wrong many times and still be rich. But one mistake that is too large, everything ends. If you do not want to sell because you believe, feel uncomfortable. When thinking about reducing the position, think that this one is different. It won't fall like the others. You are no longer investing. You are trapped. No asset should make up more than 5 to 10% of a portfolio, no matter how much you believe in it. Not because you are wrong, but because you cannot control the future. If there is something in your portfolio that you believe in more than everything else, that might be the very thing you need to review first. But even if you are not caught in this trap, there is still another way your money gets drained silently without emotion, without warning. And the scary part is, many people lose hundreds of thousands of dollars without even realizing it is happening. Part 4: the silent bleeding trap taxes and structure. You don't see it. There is no notification. There is no emotion. But every year, your money is still being taken legally, and most people only realize it when it is too late. You invest well. You earn profits, but how much do you actually keep? This is the question that separates those who have assets and those who keep assets. The mistake is not that you invest incorrectly, but in how you structure cash flow and timing. You can sell the right asset, but at the wrong time. Choose the right investment, but place it in the wrong account. Earn profits, but lose most of it to taxes. And none of this feels like a mistake. A study by Morningstar shows, on average, investors lose about 1 to 1.5% of returns per year just because of taxes. It sounds small, but after 20 years, you could lose up to 30 to 35% of your total final wealth, not because of poor investing, but because of poor structure. You earn $50,000 from an investment. If you sell after 1 year, the tax is significantly lower. If you sell a few months earlier, you could lose nearly 20% more of your profit. Just because you didn't wait a little longer. You are not only investing in the market, you are investing in the tax system. And if you don't understand it, you are playing a game where the rules are already against you. Beginners ask, what will go up? Professionals ask, how do I keep most of that profit? Because they understand. Earning 10% is not as important as keeping 8% rather than earning 12%, but only keeping 6%. Common mistakes: trading too frequently creates continuous taxes. Placing assets in the wrong location, for example, high-income assets in taxable accounts. Not using losses to offset gains. These things don't hurt immediately, but are extremely costly in the long run. Core principle: investing is not only about choosing assets, but about choosing the right structure. Holding time does not only affect to returns, it directly affects how much money you keep. If you are focusing on picking the right stocks but have never thought about taxes, you may be working very hard to make others rich. And even if you avoid all of that, there is still one more trap that causes many people to appear wealthy, but actually be cash trapped. Their assets increase, but their ability to control their life decreases. Part 5: the rich, but not free trap liquidity. You look at your assets and see a very nice number, but when you need real money, you can't access it. This is when you realize you don't lack assets. You lack access to those assets. Many people reach a dangerous state, appear very rich, but live very constrained. Their money is in real estate retirement funds, long-term investments that are locked and almost impossible to convert into cash quickly. Analysis from Bloomberg. The 1 to 2 million USD asset group has about 66% of assets in illiquid form, which means most of their assets cannot be used immediately when needed. You have a house worth billions, a long-term investment, portfolio, a retirement account that is growing. Looking at it, you are rich. But when an opportunity or unexpected risk appears, you cannot mobilize 200 to 300 million in a few days because everything is locked. Assets do not create freedom. Liquidity creates freedom. Average people maximize returns. Skilled people optimize flexibility because they understand opportunities only exist for a short time, and only those with available cash can take advantage of them. When you are liquidity constrained, you cannot invest when the market drops. You cannot seize opportunities. You are forced to sell assets at the worst time. Not because you are wrong, but because you have no choice. Core principle. Always keep 3 to 6 months of living expenses in actual cash. At least 15 to 20% of assets should be convertible into cash within 30 days. Do not invest everything. Do not all in into long-term assets. If all your assets are increasing in value but you still feel constrained, you may not lack money, you lack liquidity. But even if you have cash, there is still more subtle trap that makes many people think they are safe, while in reality, their entire portfolio can collapse at the same time. Part 6. The false diversification trap. You think you're safe, but you're not. You open your investment portfolio and you see 5 to 6 different funds, multiple accounts, many different asset types, and you feel reassured. But the truth is, all of them may be falling at the same time. This is one of the most dangerous illusions I have. Many things I am diversified, but in reality, different names do not mean different risks. In finance, there is an important concept: correlation. If assets rise together when the market is good, fall together when the market is bad, then you are not diversified at all. You are simply repeating the same risk. In the 2008 financial crisis, correlations between assets increased sharply. Almost all stock groups declined at the same time. Those who thought they were diversified still lost money the same way. You have S&P 500 ETF, technology ETF, growth ETF, a few large cap stocks. It sounds diversified, but in reality, all of them depend on the same factor, the U.S. to stock market. Diversification is not about quantity, but about real difference. People who are good with money do not ask, how many assets do I have? They ask, how do these assets react when things go wrong? Because they understand you don't need protection when the market is good. You need protection when everything collapses. If your portfolio rises strongly when the market rises and also falls sharply when the market falls, you are not diversified, are just amplifying volatility. Core principle. True diversification requires different types of assets, not just stocks. Assets that react differently in a crisis, not depending on the same macro factor. It does not need to be complex. It just needs to be different. If you feel your portfolio is very complete, but have never checked whether they share the same risk, you may not be as safe as you think. And when all those assets fall together, something else will appear stronger than any strategy. Not the market, but your own emotions. And that is where most people lose. Part 7. The emotional trap. You don't lose to the market, you lose to yourself. When the market rises, everything feels easy. You are calm, you are confident, you trust the plan. But when the market drops sharply, you are no longer the same person. When your account is small, a 20% drop, you lose an uncomfortable amount. But when your account is large, a 20% drop, you lose an amount your brain treats as real danger. And that is when logic starts to disappear. The human brain is not designed to process losing hundreds of thousands or millions on a screen. It reacts as if you are losing a source of survival, triggering loss aversion. The pain of losing money is stronger than the joy of gaining money, and the more money, the stronger the reaction. According to Dalbar, over 20 years, market grew significantly, but the average investor earned far less. The reason? Not because they chose the wrong assets, but because they buy when they feel safe, sell when they feel afraid. In 2020, When the market crashed, hundreds of billions of USD were withdrawn. People thought, we have to sell to protect money. The market leaned freely. Lean ding ding lean ding dee. Lean Lindy fru. Lindy fremas. Lindy. We have to sell to protect money. The market did not get back in time. You do not lose money because the market drops. You lose money because of how you react when it drops. People who are good with money do not try to control the market. They control their own behavior because they understand the biggest enemy is not volatility, but wrong decisions during volatility. The most important moment is not when you buy, but when you want to sell out of fear. If you don't have a plan beforehand, you will always act based on emotion. Core principle. Set your strategy before the market becomes volatile. Automate investing to reduce emotional decisions. Do not check your portfolio too frequently during bad periods, because when emotions are high, logic is almost useless. If you have ever sold out of fear, then watch the market rise again. You are not alone, but you need to change before it happens again. And even if you can control your emotions, there is still one final mistake that many people delay until the end of their lives. And the cost of it is not only money,